Hey traders, Raghee here, and in this update we're going to go ahead and talk about a question that I've been getting quite a bit, and that is this a market to short? So let's cover that first. No, I am absolutely not looking to short sell this market. No way. Now, but let's talk about why. All right, first of all, clearly Jerome Powell has changed the narrative, and you can see that shift, especially in Friday's candle, which is this one right there. This is absolutely a weekend later, maybe a couple conversations and soaking by the pool or getting out and getting some fresh air, who knows? But the market came back on Monday and has pretty much invalidated Friday's move. It's amazing what a weekend can do. A little bit of reading, actually reading the statement, actually reviewing what was said during the press conference, and traders really thought, yeah, we overdid it. So can it be that psychological sometimes? Can traders make that big I won't say a mistake, but that big a bet on something that came out of the Federal Reserve's mouth on a month that we actually see higher asset purchases? Why get scared about a monetary policy shift or the hinting of one, where now 2023 is where the expectations are for a potential rate hike? Well, the reason is the reflation trade, which definitely took it on the chin, and equities in general, which have benefited from a low interest rate environment. Traders are going to start to reconsider the positions that they have. Well, I think two things happen. One, there's a bit of a panic sell, and selling, we know, begets more selling. So let's go out to the weekly time frame just for a moment, and we're going to look at all the indices separately. Take a look at the trend on the weekly S&P. That was last week's candle. We haven't even taken out lows from early May. So no, I'm not looking at this as a downward trending S&P market, nor am I looking for a short. How about the NASDAQ? Tech really came on pretty darn late in terms of strength on the daily, but interestingly enough, it's been a fantastic market to buy pullbacks in on the weekly. And I think smart, longer term money has been buying these pullbacks. Well, then that brings us to a really quick question. And it's actually a really easy question. If the indices are generally speaking heading higher on the weekly, so longer term time horizon investors and traders are thinking, I'm not bailing. In fact, last week gave me a buying opportunity. And then intraday traders are saying, well, I may not want to run back into those reflation corners of the market in terms of materials or transports or even certain commodities. We know that as market participants of different time horizons, day trading, position trading, investing, right, are reassessing where the money's going to go, because it doesn't go under the mattress, does it? All right, so with that being said, I really like XLE still. I would still be a fan of XLF, but more specifically corners of the XLF. In other words, being a stock picker and looking for relative outperformance. Schwab, American Express, BlackRock's doing actually pretty well right now. You can also see SPGI, again, very much intact in terms of the uptrend. What parts of tech are looking really good? The same parts that always have. You can look at XLC. I like Facebook a lot, coming off this 21 and the 34 EMA on the high. So there's corners of this market that look really good. Now, if you looked at last week and thought, my gosh, thanks but no thanks, that was just too much insanity, and I really don't trust Powell and his merry band of Federal Reserve members, because I'm not really sure how much they could flub the message. Some of us might remember back in Bernanke days how bad he flubbed that message, and how much the market struggled through 2013, 2014. Well, some of us, like myself, remember that really well, and we may not want to, really hang too much confidence on the Federal Reserve getting the messaging right between where we are now with plenty of asset purchase to eventually a taper and then rate hikes. Well, the easiest way to handle that is shorten the time frame, at least for the next week or two, at least, or maybe through summer. So we really don't care what the clarity is session to session, but rather, for example, for me, I just want to see some clarity between 9:30 a.m. Eastern And about 11:30, I'm going to look to trail some stops or have some break-even stops after 11:30, and then I'll see how high is high, if anything at all, knowing that the bulk of what I want to take advantage of is just happening in this area. So 120 minutes of clarity. That's all I'm looking for every day as a shorter term time frame trader. So let me show you a couple interesting things. The NASDAQ. The NASDAQ is a market that a lot of folks are looking at right now. Let's shorten the time frame. Okay, let's shorten the time frame. What does that mean? I'm going to take a look at a 5-minute chart, and then I'm going to go ahead and say, being bullish, being a buyer, my directional bias is bullish, right? So that means I'm going to look for buys only, right? So I'm going to trade with the bulls, trade with the buyers, and then I'm going to look for opportunities based on time. We already talked about time being 9:30 to 11:30. Time volatility, that takes me to my hourly price movement range, is the tool that I created trading Forex back in 2011, 2012. Discussed this data in my last book, and I think 2009 or 2007, might as well be a million years ago. And then we have an indicator that syncs up to this data. This is called the hourly price movement range. It's a volatility tool. Then we've got the Darvis down in here. This is a price-based pattern. Good old-fashioned 60-year time-tested Darvis pattern, all right? Now, the interesting thing about being able to use another tool, I'm going to walk you through it right now. This is going to be volume. And I'm going to look at what the lowest point of standard deviation of the volume weighted average price was between 7 a.m. and 9:30 a.m. Eastern. So I'm going to set my V-Score tool. This is a tool that I created back in 2008 to rebuild my portfolio. And then I thought, wait a minute, if I was studying standard deviations to rebuild and manage my portfolio after the financial crisis, can I day trade with it too? Sure can. Here is my V-Score, standard deviation low, priming the pump, so to speak, for a buy, Darvis, HPMR. And so what I can do now, and you can do this too, is just ask yourself, can I just focus on the first 120 minutes of the market, at least for the remainder of June, right? Can I just keep really short-term time frames as this market sort of processes whatever the heck Powell said last week, keep it short-term, and then in June, start to reassess. Or, you know, it could be a couple weeks, it could be 4 weeks, could be 6 weeks, we don't know, but can I keep it really short-term and not rely on the market to behave as it did with the clarity that we saw probably through most this year, especially with the reflation trade? You know, can I just not care? And the easiest way to not care, it's a wonderful strategic apathy, is to simply shorten the time frame and shorten the time horizon, okay? So I hope that makes sense. This is kind of taking baby steps into dealing with summer, where usually I'm a day trader, so the timing for this couldn't be better. We're going to go into the day trading playbook this Saturday at 1 p.m. Eastern. You can check it out over at simplertrading.com/climb. That was the webinar that I did where I go into a lot more detail about the 4 factors you need to know to be a day trader. In fact, to be any kind of trader: time, price, volatility, and volume. And not necessarily in that order, but understand how they all synergistically work together. The fringe benefit of this, and I love when we're going to dive into it this time around, my short-term approach. Think about the importance of the daily time frame. The most psychologically significant time frame you're going to look at is the end of day or daily chart. Before the bell even rings, I've done different types of analysis on the daily to determine if I want to be a buyer or seller for that 120-minute segment of the day. So a lot of daily time frame analysis should go and does go into the way in which I day trade. The fringe benefit of that is not only better day trades, but the knock-on effect is, wait a minute, I'm going to be able to find daily time frame, longer term setups as well. So when this market starts giving me the clarity that it was giving us through, say, late March, April, May, and into June, when that clarity comes back, I will already have been also anchored to that time frame, and I'm just not going to get lost in the 1-minute charts. And remember, you don't want to get lost in the 1-minute charts because you won't see the forest. You're just looking at the leaves on the tree. So having that different perspective is very important. I hope this helps, gives you an idea of what we need to do now in this environment, what I've got coming up on Saturday, and I will see you all in the next update. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.